Alphabet's most recent earnings were not just strong, they were historic. The company crossed the $100 billion revenue mark for the first time in a single quarter, landing at roughly $102.3 billion and showing nearly 16% year-over-year growth. That level of expansion at Alphabet's scale is extremely difficult, and it highlights how steadily the company continues to execute on its long-term strategy. Earnings per share came in around $2.87, which represents more than 30% growth from the previous year, and the company achieved over $31 billion in operating income. Even with the drag from a major regulatory fine in the European Union, Alphabet maintained operating margins above 30%. And without that one-time charge, margins would have approached 34%. This combination of strong growth, disciplined cost management, and expanding margin potential is a sign that Alphabet is still one of the most efficient and profitable companies in the world, even as it shifts toward a more AI-heavy future. When you look inside the quarterly numbers, what really stands out is how balanced the growth was across Alphabet's core business lines. Google Search remains the company's largest and most resilient engine, growing at a healthy double-digit rate. Despite constant questions about whether generative AI will disrupt traditional search behavior, search remains deeply embedded in how people use the internet, and the fact that it continues to grow at this scale shows its staying power. YouTube also continued its momentum, with advertising growth accelerating in areas like connected TV, YouTube Shorts, and creator-driven monetization. Alphabet has been investing heavily in turning YouTube into a multi-format, multi-platform ecosystem, and now the results are showing up in both engagement and revenue. Subscription revenue across services like YouTube Premium, YouTube TV, and Google One also continues to expand, helping diversify Alphabet's earnings beyond ads. Together, these segments create a foundation that both stabilizes Alphabet's results and funds the company's massive push into artificial intelligence. The biggest storyline in this earnings cycle, however, was Google Cloud. Cloud revenue posted growth comfortably above 30% year-over-year, reaching the mid-teen billions in quarterly revenue. The company also emphasized the strength of its cloud backlog, which is now well above $100 billion, demonstrating that enterprises are signing long-term contracts at a rapid pace. Google Cloud's profitability continues to improve as well, showing that the division is transitioning from investment-heavy business to a scalable earnings driver. What's especially compelling is how cloud and AI are now intertwined. Google Cloud is no longer just competing on storage or compute. It is positioning itself as the premier AI-first cloud platform, offering everything from AI-optimized infrastructure to proprietary chips to the Gemini model family, to developer tools and enterprise AI solutions. This full-stack approach means Google is capturing value at every layer of the AI ecosystem. As enterprises race to integrate AI into their workflows, Google Cloud has quickly become a central strategic pillar. And this quarter's results show that the demand for AI-enabled cloud services is only accelerating. Another major theme from the earnings call was Alphabet's ramp-up in capital spending. The company expects annual CapEx to approach roughly $90 billion, largely driven by investments in data centers, advanced computing infrastructure, and AI-specific hardware. This is a massive investment cycle, one of the largest in tech history. And it clearly signals that Alphabet is not taking a defensive position in the AI race. Instead, Alphabet wants to maintain a structural advantage in compute capacity, custom silicon, and global distribution of AI services. These investments may pressure free cash flow in the short term, and investors should expect some volatility in margins as the company spends aggressively. But Alphabet is betting that demand for AI computing will continue to rise for years, similar to how demand for cloud services grew throughout the 2010s. If the AI boom unfolds as expected, Alphabet will be one of the companies best positioned to supply the infrastructure that everybody else needs. Despite the strong quarter, investors should remain aware of several risks. The first is regulatory pressure. The EU fine this quarter is a reminder that Alphabet operates under the constant risk of antitrust scrutiny, privacy regulations, and legal challenges across multiple jurisdictions. These actions can result in fines, forced product changes, or limits on how data can be used, all of which could impact growth. Competitive pressure is another major risk. AI has levels of competition that Google has never seen before, not only from Microsoft and Amazon in cloud, but also from OpenAI, Meta, and a long list of smaller AI labs and open source communities. Alphabet needs to execute flawlessly to maintain leadership, and history shows that companies at this scale can sometimes be slow to adapt. Additionally, while search and YouTube remain very strong, they are still tied to digital advertising, which can be sensitive to macroeconomic conditions. If the global economy slows, advertising budgets are often the first to be cut, which would affect Alphabet's revenue in the short term. Even with these risks, Alphabet's long-term outlook remains incredibly compelling. The company is essentially running two businesses at once: a highly profitable and mature advertising empire and a rapidly growing, capital-intensive, AI-driven cloud and infrastructure platform. The advertising business generates the cash that allows Alphabet to invest aggressively in AI, and the AI business provides the long-term growth runway that keeps Alphabet relevant and competitive for the next decade. Very few companies in the world have this kind of financial strength, brand power, user base, and technological depth. Alphabet controls the world's most widely used search engine, the largest video platform, one of the fastest growing cloud platforms, the most widely used mobile operating system, and now a full-stack AI ecosystem that reaches consumers, developers, and enterprises. For long-term investors, Alphabet still looks like one of the strongest mega-cap stocks in the market. The combination of durable cash flow, diversified revenue streams, industry leadership in AI, and massive infrastructure expansion makes it an attractive choice for investors who want exposure to the next era of tech growth. For more conservative investors, Alphabet also provides stability thanks to its dominant advertising business and consistent profitability. Even though the company is spending heavily right now, it is doing so from a position of strength, and the returns on those investments could be enormous if AI adoption continues accelerating. The short-term risks are real, but so is the long-term potential. If you believe that AI will reshape every industry, and that companies with the biggest data, the biggest cloud networks, and the biggest compute power will be the winners, then Alphabet is positioned exactly where you want to be.